Nifty fell 495 points. Sensex crashed over 1500 points, and approximately 10 lakh crores of investor wealth evaporated in a single session. Many are attributing this to a Sunday effect or thin liquidity. But if we look at the underlying mechanics, the story is far more complex. Today, we are moving away from the surface level noise and looking at the actual institutional shifts. We will break down the 4.3% fiscal deficit and 12.2 lakh crore capex, and the structural changes in education and technology. Make sure you stay until the very end, where I'll be answering the 10 most critical questions that can resolve most of your queries regarding this budget and your personal finance. This isn't just a budget review, it's a deep dive into the survival guide for the post-budget landscape. Let's address the common observation that Sunday participation was the cause of the volatility. While it's a popular theory, the data tells us that market engagement was actually quite intense. India VIX spiked 14.3% to hit 16.11. This suggests that professional hedgers and institutional desks were very much active. This wasn't a lack of buyers, it was a concentration of high conviction selling. We saw a technical breakdown of the moment the STT hike was confirmed. The Nifty breached its 50-day EMA, which triggered algorithmic stop losses. In a market that has been trading at premium valuations, any shift in the cost of doing business can cause a cascading effect. This was a technicals-driven flush out where the hope trade met a very disciplined fiscal reality. Let's talk about the most discussed change, the STT hike. Tax on futures was raised from 0.02% to 0.05%, and tax on options was raised from 0.1% to 0.15%. While these might seem like small basis points, for a high-frequency trader or a retail scalper, the math changes significantly. Your transaction costs on a Nifty lot have increased by roughly 150%. The intent here appears to be volume moderation. The regulator has been very vocal about the risks in retail F&O segment, where a high percentage of participants face losses. Last year, 91% of retail traders were in loss. By increasing the friction, the government is essentially nudging capital towards more long-term cash-based investing. A major reason the Sensex felt the heat was buyback taxation overhaul. Traditionally, buybacks were a tax-efficient way for IT giants to return value to shareholders. The Finance Bill 2026 has fundamentally changed this. Buyback proceeds are now taxed in the hands of shareholder, similar to dividends. So if a global fund was valuing a stock like TCS or Infosys based on a certain post-tax yield, that yield math has now been disrupted. So this wasn't a panic sell, it was a mathematical recalibration. Institutional investors are adjusting their fair value model because the net return to the shareholder has decreased due to this tax leakage. Now, let's look at the section that hits home for many of you, education and the future of your kids. If you are in the 35 to 54 age bracket, the sandwich generation, you are balancing your parents' healthcare, your children's skyrocketing education costs, along with other household costs. And the reality of the school fees is that it hikes every year, and many of us hoped for a hike in the Section 80C limit to account for school fees. That didn't happen. In 2026, 1.5 lakh is exhausted almost immediately by a middle-class parent. This means for most of you, education is being funded by 100% taxable income. The foreign education and IIT hubs were also announced in this budget. However, there is a massive cash flow relief on those. The TCS on foreign education remittances has been slashed from 5% to 2%. If you are sending your child abroad for a master's degree, you no longer have to lock up lakhs of rupees with the tax department for a year. Furthermore, the government is launching IIT-linked creator hubs and content creator labs in 15,000 schools. This is a clear signal that the government recognizes new age careers. They are integrating technology and digital skills into a formal education system to ensure the next generation is job ready for 2047. In tech space, ISM 2.0, India Semiconductor Mission, is receiving a 40,000 crore outlay. This is about localizing the supply chains. EMS companies like Dixon or Amber could see a 200 to 300 BPS expansion in operating margins by reducing import friction. Simultaneously, the data center tax holiday until 2047 is a strategic move to turn India into a global data hub. This drives demand for specialized real estate and green power. On the macro side, the fiscal deficit of 4.3% shows world-class discipline. However, the gross borrowings of 17.2 lakh crores is significant. High borrowing keeps bond yields firm, making it difficult for banks to lower deposit rates, which keeps your home loan EMIs sticky. As promised, we are closing this masterclass by answering the 10 most critical questions that have emerged from this budget. These aren't just tax tips, they are the blueprints for your financial health in 2026. Question 1. Is the 1500-point crash a fundamental reset or a technical correction? Let's look at the India VIX at 16.11. A technical correction is usually driven by a lack of buyers. The fundamental reset is driven by an abundance of sellers. Today was the latter. The market was priced for perfection, and when the STT and buyback taxes hit, the yield math for the top 50 stocks changed instantly. The verdict, it's a fundamental repricing of valuation multiples. We are moving from premium India to fairly valued India. Expect the Nifty to trade in a wide range, 24,200 to 25,500, until the Q4 earnings prove that corporate India can absorb these tax costs. Question 2. Does the STT hike on FNO structurally kill the retail traders' edge? For 93% of retail traders who already lose money, according to SEBI, the edge didn't exist to begin with. But for those serious traders, the increase from 0.02% to 2.05% on futures and 0.15% on options is a massive impact cost. The math, your strategy now needs to yield another 15 to 20% annually just to stay at the same net profit level after taxes and charges. The government is effectively turning the casino back into the market. The winners in 2026 will be positional traders and not 1-minute scalpers. Question 3. Why did IT giants bleed despite a tech-forward budget? It's all about the buyback dividend substitution. By taxing buyback proceeds at the shareholders' slab rate or 12.5% LTCG, the government has closed the door on tax-free cash returns. The strategic shift is that large IT firms like TCS and Infosys sits on billions in cash. If returning that cash now costs 20 to 30% in tax leakage, their return on equity naturally compresses. This market isn't telling the tech story, it's selling the inefficient cash story. Question 5. For NRIs, is the 10% individual limit a golden entry? Previously, NRIs were capped at 5% per company. Doubling this to 10% via the portfolio investment scheme is a massive signal. The opportunity, this allows wealthy NRIs and family offices to take significant influence stakes in mid-cap companies. If you are an NRI, you no longer just are a passive investor. You are now a strategic stakeholder. Watch for NRI heavy buying in high growth sectors like specialty chemicals and renewables in the coming days. Question 6. Why are home loan EMIs unlikely to fall? The government is borrowing 17.2 lakh crore. Even at a disciplined 4.3% deficit, the sheer volume of supply in the bond market keeps the yields high. The reality, banks need to keep deposit rates high to attract money away from booming stock market. If deposit rates stay high, cost of funds stay high. Your EMIs are likely to remain flat. Do not time your home purchases based on expected rate cuts in 2026. Time it based on your cash flow. Question 7. How does the new Income Tax Act 2025 reshape the landscape? The Act, effective till April 1, 2026, is a 50% reduction in the volume of tax code. It's about ease of compliance. The shift. By allowing tedious credit even on late filings and staggering return deadlines, the government is admitting that the compliance burden was killing the middle class. However, the lack of ATC hikes in the new regime confirms that the era of tax saving through insurance is over. You now save to build wealth and not to save tax. Question 8. Which 3 hidden sectors are real winners? Sector 1. Semiconductor allied services. Don't just look at the chip makers, look at the companies providing high purity chemicals and glasses. Sector 2. Data center power. Foreign cloud providers get a tax holiday until 2047. They need 24/7 green power. This is a 20-year tailwind for renewables. Sector 3. Inland waterways. With 20 new waterways being developed, logistics companies can pivot to coastal shipping, and they will see their operating margins explode compared to road-only players. Question 9. What was the intent behind the TCS slash on education? Remittances for education above 10 lakhs saw TCS drop from 5% to 2%, and travel packages saw it drop from 20% to 2%. The insight. The government realized that locking up 20% of a middle-class family's travel budget for 12 months was hurting the domestic aviation and travel industry. This is a liquidity injection for the sandwich generation parent. It's not a tax saving, since TCS is refundable, but it's a cash flow saving, allowing you to spend the money elsewhere in the economy now. And it saves the government a lot of paperwork. And now, the most important question. Should you buy the dip tomorrow morning? Or in fact, today morning as I record this video. So think about it like this. The smart money is waiting for the FNO expiry and the RBI monetary policy following the budget. The playbook. If the Nifty holds above 24,500 with high volume, it signals a bottom. If it breaches, we look at 23,800. Do not deploy all your cash at once. Use the staggered entry. Buy 20% now and keep the rest for when the India VIX cools down to 13% or below. Patience is the greatest asset in a post-budget market, as you must have seen in all other years. So we have covered the crash, the taxes, the tech, and the future of your children's education. So this masterclass was about one thing, clarity. The 1500-point fall wasn't a funeral, it was a reset to make the next rally sustainable. India's macro fundamental, 4.3% deficit, record capex, and a localized tech supply chain are the strongest that they have ever been, including the banks, which are sitting at their least number of bad loans. So panic nahi, planning hi kaam aayegi. If this deep dive gave you value, hit that subscribe button and share this with one person who's panicking today. And I will see you in our next sector-specific analysis. Stay smart and stay grounded. Also check the comments for the companies that we have identified which are trading on NSE based on the budget which will benefit the most. If you're here, why not go ahead and check it? So thank you for your time and thanks for tuning in. Bye.